Well, I hope I'm audible, right? Let me hear from you. How are you doing? How did your day go? I don't know if my internet is stable, and you have to alert me if for any reason you are unable to hear me. I don't know if I'm audible. Slow day to be, but doing well. Great, Mamle, good. My day has been cool so far, Clement, and like I say, we can hear you. Oh, great, great, great. Thank you. I've been busy. My day never ends. Hi, Eric, and Sam has been busy. You could say great, great. So, well, we have a couple of stuff to do today, and today's class is going to be more involving than what we've been doing in the last few days. And I think this class is going to be a little difficult, but I want to assure you that I want to clear every possible doubt that you may have as far as this stuff are concerned. So, in case you have difficulties understanding something, maybe a point was made, but you struggle to understand, always draw my attention to it. Now, so we've been talking about discount rate and how to form capital market expectation. We looked at how to estimate risk-free rates on Friday. That was lesson 3, and lesson 4, which was yesterday, we looked at how to estimate equity risk premium. And the whole thing is that the equity risk premium that we learned, or we looked at how to do with equity risk premium for a developed market. You see, a developed market equity risk premium. And that developed market equity risk premium too is not equity risk premium for every company in that developed market. You see, we were using the S&P 500, and the S&P 500, tracks the top 500 firms or corporations or public companies in the United States. So the analysis we are doing was actually for large companies in a developed market, large public company or public companies in the developed market. That's the analysis we're doing. And we've never gotten back or gotten to even the level of an emerging market companies, like the companies in Ghana, the company in the United States, in Nigeria, the companies in South Africa. We've not gotten to those levels. We are still at the level of the developed market. We are still operating in the United States. So whatsoever we're coming to do, just assume that we are still in the United States. All analysis are being done as though we are in the United States of America. So let's get into it and see. So today, still on the capital market expectation, today we're going to be actually covering beta statistics, how to estimate beta, and also emerging market considerations, certain emerging market matters. We're going to handle all of those stuff today. Just a moment, sorry for that. We'll cover some emerging market stuff today as well, and finally how to estimate equity or cost of equity. But one thing I want to tell you also is that I may use more than the time here. So you can stick with me if you want to know more. But I want to encourage you all to stay with me, because what I'm coming to do, I want to complete it today. I don't want to extend it to another day. Today, I'll be using some stock data as well to show you a number of things, right? Okay, so let me get into some few stuff here. And the first thing I want us to do is that I want us to estimate the equity risk premium yield on S&P 500. Initially, when I was developing this lecture slide, I wanted us to do this computation on a 30-year data, but I had a 10-year data downloaded. I couldn't have time to download a 30-year data, so we are going to work it on 10-year data instead of the 30-year data that I earlier promised. So we will do this on a 10-year data instead of the 30 years, as I mentioned, right? Okay. Now, so what we're going to be doing is I'll be switching right away, and I'll be opening my Excel sheet where I have the data. Now, so what I'm going to do, I'm going to do this on a developed market economy, or in the developed market economy. And what I've done here, I've downloaded a 10-year data, trading data, daily trading data for a stock and an index. So the index here is the S&P 500, and the stock here is the JP Morgan Chase. JP Morgan Chase is part of the S&P 500, right? It's part of the companies in the S&P 500. Now, if you look at this, you see that this is stock prices here, and this the S&P 500, the index level, right? The level of the index. And these are the prices, and they are all in dollar terms. Just a second, please. One moment. Let me just get this down. So let me just get this down. Okay. All right. Now, so that's what we're going to be doing. So we want to calculate the equity risk premium. And I want to also say that in calculating the equity risk premium, I'm going to be treating a lot of things. In the beta calculation, a lot of things we'll be learning today. I'll be moving in between the PowerPoint and the Excel. And I hope you can all see my Excel. Can you all see my Excel? Let me see, maybe someone should indicate in the chat if you can see my Excel. Oh yes, my Excel can be seen. Now, so let's get to it. What we're going to be doing is that we're going to be analyzing this historical data. Suddenly my cursor is freezing, or has freeze. Sometimes I don't know why some of these things just happen. Let me reopen the Excel. Let me share my screen again. I pray I don't encounter things like this today. I want to have a smooth smooth session. Okay, good. So I have that. So I have my date here, and I have my stock here, which is the JP Morgan, and I'm just going to call this JP, right? And the S&P 500 here, I'm going to call it the index. Yeah, so let me call it. Maybe I can just leave it at S&P 500, right? And I have the whatever here. I want to shift this one step, or maybe 4 steps down. I want to shift this 4 steps down. And what I want to do here is that I want to call this is daily spot price. So you see, I didn't do the work before coming. I'm doing everything here. Sometimes it takes a lot of time. If you got to do that, it's just energy draining, right? We have daily spot. So these are spot prices. So I want to call this daily spot, and maybe I can merge this here, and then of course I do some. If you're like me, you like to be color coding your stuff, and I can change this to white, and I have my daily spot here, and I do this. I do this for the daily spot. Now, one thing I want to do again, after getting all these things, is to calculate the returns. So I'm going to calculate the return on the index and return on JP stock. So I'll have my stock return. Let me, even though I've arranged, well, let me just do with the stock return here. Stock return. I have my stock return, and I also have my index return. Now, so how I'm going to calculate the return, I'm just going to use simple averages. You see the dates. At the time I downloaded this stock, if you look at it, this is on the 13th of, this from 2015 to date, okay? So 13th of April, then 14th of April. So I have to start calculating my returns from here. And so that I can take, this is for the stock, I'll take the current divided by the previous stock price minus 1. That's the price change you look at yesterday that I can drag. So I have for the index as well. Then I just drag down. So I'm cool with this. So this is fine. Now, the next thing I want to do, of course, I like to dress things up, right? So I can go for these colors, a color like this. And then I want to call these the daily returns. So these daily returns in this column. So I have my daily returns. And I can use this color for the daily returns. Maybe even these, I should have been using a deeper color like this and changing this way. And then I use a lighter one or this one and a lighter one for this one as well. Something like this. So, well, we're making progress, right? Now, I have my returns. So right away, I can calculate some statistics. Once I have the daily returns, one thing I can do is to, I want to express these things in percentages, right? And I'm going to test a number of things. So even though I have later slides, a lot of things I'll do them in Excel, and then I'll just run into the PowerPoint to explain to you the theory. So I'll be doing implementation right away. And then so going to the later slide to explain to you, it's just a matter of running through that, because the most important thing must have been expressed or maybe explained here, right? So I'm expressing my things to 2 decimal places, and that's how I want to do my work, right? So I have these, so I can calculate some statistics. Well, even before I do my statistical analysis, let me explain to you the reason why we don't work with the stock data, but we work with the return data. Let me show you something. If I take the S&P 500, if I take the S&P 500, for example, I highlight the S&P 500, I'm going to plot it in a line graph, right? I'll plot it using lines, and we'll study the shape of the graph. So let's go and plot the S&P. So come here. I want to just do a simple plot of the S&P 500. It's been plotted. So I copy the graph, then I move it to the top. I copy the graph and I move it to the top. So I move the graph to the top. I don't want to be using a lot of shortcuts because I'm teaching online. So I'm trying to manually move things, and for a reason. So I paste it here. So this is the S&P 500. So we can name these S&P 500. Anytime you are doing stock analysis, you need to be plotting the graphs, you know. You got to plot the graph to see, whichever way you're doing, you need to plot the graph to see how the stock is behaving. So the title of this is S&P. So S&P 500. So this stock price or index level. This is the index level. Now, so you see the index rising over time. I didn't plot it against time. So otherwise, you would have seen the various years and when the index was high and when the index dropped and all that. You see all those things happening, right? Well, I always want to put my things this way. So I have it plotted this way. So I have the S&P index here. So if you look at the stock price, there's something I want you to know. That you see the trend is rising over time. If I take the variance along this area, around this area, if I take the variance, okay, if I take the variance along this area, the variance is likely to be different from the variance if I take it here. And also, if I take it here, okay? So there's no stationarity in the data. So I'll see those things happening. The variance tend to be different over time, maybe depending on wherever I pick it from. But now let's look at something here. Another way you can look at it when I say variance is that if you take the average stock price here, the average stock price here will be different from the average stock price in this region, and this region to the average stock price will be different. So I will not want to work with stock prices when I'm doing my analysis. because of the issues associated with stock prices. The average stock price tend to be changing over time. I want to let me pull this up. It's changing. It's when I take the average stock price, different region, it tend to change. Now let's plot the JP. Let's plot JP. When we plot JP, we're going to see how the story differs with JP. And sorry, do I say how the story differs? Maybe even instead of plotting JP, I should just go straight and plot the index return. So we plot the index return. I meant index return. I said JP. We plot the index return, and we see how the story differs when it comes to the index return. And you're going to see it clearly here soon. So I'm picking the index return. I'm going to same insert, and I want to insert a line graph. Let's look at how that's going to look. So I'm going to copy this again. Let me copy this, and then I move to the very top, and I should have cleaned all these things here, right? Now, so I then paste this one to here. Let's see how it looks like. And an annotation, let me get this, but let me get to clean all these things here. I want to see what's happening here. Let me annotate this. Okay, I think it's fine. What is happening? Okay. All right. So let's look at it. Now, if you take the average return around this region, it will not be different from the average return around this region. Now, we have these spikes here, and you can see where this is coming from. This is a 10-year data. So this dates from 2015 to date, right? So we are seeing the COVID period here. This is a COVID period where we have significant volatility on the market. So the S&P reflecting that. But even if we take this out of the story, the returns, the average returns here wouldn't be different from average return here. In other words, the variance of the returns here and the variance of the returns here tend to be similar. It's kind of like the returns are, the covariance is actually stable. Would you need a subscription on S&P before you can download the stock price? Oh, no, you don't need a subscription. Oftentimes, I write Python codes to download this. So it's just writing some few codes in I often use, I don't use a Jupyter Notebook. I tend to use Google Colab. Google Colab is right in your Google Drive. So you can write a couple of Python codes there to download it. So you just run it and download the stock price for you. And sorry, sir, but I have to leave for a meeting. So thank you. We'll be sharing the slide. Yeah, we'll be sharing. All your slides will actually be shared today. You can get it on Google Finance. Yeah, Google Finance too can provide you that, right? Now, so that is what we're doing. So that's the reason why we use stock prices rather than we use stock returns rather than stock prices. I don't know why today I tend to be misusing my words. Now, that being said, let's do some statistics. So I want to move these graphs to the right, a bit to the right, so we perform our statistics. Now, so let's do some statistics here. So I'm going to call these statistics, and we are going to calculate some statistics right now. And the first one we calculate is the average daily returns. We'll do it on both, or we calculate it on both the stock or JP, and then we do S&P 500. S&P 500. Now, then we also calculate average volatility, average daily volatility. Let me put that there. Daily volatility. Why am I even calling it average daily volatility? It is just daily volatility. And then the next thing we do is then to analyze whatsoever we've done. So we have analyzed returns, what am I writing? Analyze returns and analyze volatility. Now, the annualized volatility, by definition, volatility is an annualized standard deviation. So annualized volatility is just to say volatility, right? So let's do this computation and see the results. See what the results will be like. Now, average daily returns, we already have the daily returns calculated using this simple return calculation methodology. So the the daily returns is just to take the average of all this. I don't want to waste my time doing a lot of things, so I'm going to do something now. I want to see the range of data, and then the range of data is, or the ending value is basically, I told you I don't want to use a lot of shortcuts today. So 2520, row 2520. So I know this starts from 7. So I know this will be G7, G2520, something like this, right? So this is what I'm going to copy, and then I'll be putting them in the functions. Now, so if I come here, average, then I put this in function, then I move it to where I want it to be. For example, for the stock, for the JP, we put it here and we hit enter. That gives us the average. Then I can actually drag that to S&P 500. So this is what we have. JP is giving us 0.08% return average on daily basis, and that of S&P is 0.04%. In fact, if I increase the time period over and over and over again, you see these returns even approaching 0, right? Now, for daily volatility, we are going to use the same thing. I want to assume that this is not a population data. Maybe let's just say this is a population data. It's not a sample, but it's a population data, right? If it is a population data, then we can use the standard deviation for population. So standard deviation for population. And that will be the same thing we have, but then you just move it to, and then hit enter. Okay, there's an error there. I introduced double brackets that's supposed not to have done. So I have this here as well. So this is the daily volatility. We have it calculated. Now, I told you something that in the short term, because these are daily numbers, short term, look at the volatility, but look at the returns in the short term, maybe in the short term. Volatility is often higher than the returns, right? The daily returns. And you see JP generating daily return of 0.08% at a cost of 1.7 for volatility. And then if you look at S&P at a cost of 1.14% volatility. Volatility is lower in the S&P, and so is the return. And also you see volatility is higher for JP Morgan, and then also the returns. To analyze this return, we learned the formula that returns increase with or proportionally to time. So there are 252 trading days in the United States. So you just multiply these by 252, then you are good to go. When you come to S&P to the same thing, 252. So this is the annualized returns on the S&P and JP Morgan respectively, 18.95, then 10.34. Now, annualized volatility, unlike returns, volatilities increase by, or is proportional to the square root of time. And we looked at all this yesterday. So time is 252 days, then you multiply that by volatility. All right, so we have this, the square root of time, and then this is all we have, annualized volatility as calculated. The volatility is still higher in a JP compared to the S&P. And it makes some sense because S&P is an index. Now, when you run a portfolio, you may want to look, if we consider, let's say JP, you want to see the risks associated with JP and want to know maybe which proportion of risks or what proportion of the risks that we are bearing, the 27%, is coming from the market, and the proportion that is coming maybe from company-specific risks. You can do those risk decomposition. We call it risk attribution. And that's why you tend to attribute these to specific risks, which is the idiosyncratic risks, and then the systematic risks. And that can easily be done, but it may require some linear algebra, right? Now, so this volatility is a total risk of the asset, but that is not entirely the market rate. This is a total risk of the asset. JP Morgan is a total risk. This is a total risk in this asset. But if you look at the S&P, this is not a total risk. The reason is that S&P is a well-diversified portfolio. So there is no company-specific risk, or just to say the company-specific risk is almost non-existent because it's a widely diverse or it's a well-diversified portfolio. So the company-specific risk is just with the JP here, right? So, well, you want to now talk about, well, what portion of these JP's risks here comes from market, right? Exposure to market. Then that's where you start thinking about your beta and all those kind of stuff. Now, this is what we have: annualized return and annualized volatility. Suppose we're giving risk-free rates. Suppose we're giving risk-free rates, and let's say the risk-free rate in the United States is 4.5%. If we know the risk-free rate to be 4.5%, then the next question we're going to ask is, what is the equity risk premium? So the equity risk premium, is the return on the market minus the risk-free rate, or the return on the stock minus risk-free rate. I'm going to explain something very soon. Return on the stock minus the risk-free rate. So this is how we calculate the equity rate. However, we are not looking at how to calculate equity risk premium for a specific stock. No, that's not what we're interested in. We are not interested in that. We are interested in calculating equity risk premium for the market, and that is what we've done. So the reasons why we are not interested in computing that for a specific stock, because the models we want to use do not assume an investment in a single stock. They assume that the investor holds a diversified portfolio, and we'll be looking at that today. So this is how we calculate the equity risk premium. I think a question there: how do you interpret the 27.58%? Oh, the 27.58% is the total risk associated with JP Morgan stock. This is the total risk. So if you invest in JP Morgan stocks alone, you are faced with this entire 27.58. But if you don't invest in only JP Morgan, you add other stocks to it, the more stocks you add to it, this total risk will be reducing in your portfolio. It's reducing because you are diversifying part of the risk away. And that is because of a correlation between your stock and that of JP, right? Between your portfolio and that of the S&P. All right. So that is how we calculate the equity risk premium, and that is like 5.84. That's not significantly different from what is reported out there. And the risk-free rate I'm using here I'm trying to talk about the 10-year risk-free rate, and must be the risk-free rate in the United States, right? 10-year risk-free rate. And don't forget also, the S&P is in dollars, the risk-free rate is in dollars. So the equity risk premium is also in dollars. So it's a dollar equity risk premium. Someone asking a question, that means it will be negatively correlated to market risk. Not necessarily negatively correlated market risk. Let's check it out and see whether there is a negative correlation. We know that to get correlation, let me put it here, correlation is equal to, correlation is equal to covariance, covariance divided by the volatility of the stock multiplied by the volatility of the market. Volatility of the market. So let's check something. To get this correlation, we just need covariance. So let's try to see if we can calculate covariance. So I'm going to consider this as further statistics, right? For a moment, so I can, because I'm going to be talking about those correlation and covariance things today. So if we calculate covariance, covariance here, we're going to do covariance, and we are taking a population, so we are using population covariance as well. Have I deleted this that I have at the top? How? Okay, let me copy it again and put somewhere. I don't need to delete it. Let it be somewhere here, so I can always use it, right? All right, so let me have it copied so I can be using it. Okay, so the covariance will be covariance of the population, and then I drop the data array, then it gives me, you've entered, no, I think I'm not done, sorry. It has to be a covariance of this, comma, the covariance of this. So covariance of JP versus covariance of the JP stock data and also the market stock data. So I captured both. So when I hit enter, it gives me this. So if the covariance is positive, it means correlation cannot be negative, because correlation is covariance divided by volatility of the stock, and volatility cannot be negative. Therefore, correlation coefficient is therefore the covariance here multiplied by the volatility of the stock here. But I'm going to do something more again. This covariance, guys, this covariance you're seeing here is a daily covariance. So I need to analyze it. So to analyze it, I multiply it by the square root of time. So square root of time will be used to, and time is 252, right? It's a daily covariance. So this is giving me a proper covariance. The earlier one was a daily covariance because I'm working with daily data, right? So it gave me daily covariance. So the same way I will use daily data to estimate daily volatility, the same thing applies to a covariance for me as well. So now I made a mistake. Let me explain the source of the mistake. You see, variance corresponds to covariance. Variance corresponds to covariance. So if variance is increasing with time, then covariance must also increase with time. When we are converting variance to standard deviation, we take the square root of it. So if what I've done here, I took square root of time, which I shouldn't have done. Well, nobody alerted me, it was a mistake from my side, which I quickly corrected. So I just have to increase it with time. Now, I have this as a covariance. Now, to get correlation is simply the covariance divided by the product of the annual volatilities. I could have done the same thing using daily covariance, but in that case, I must use daily volatility. Is that okay? Because correlation is not affected by whether it's daily or is whatever, right? When I do this, it gives me a correlation of 0.72. Now, let me use the correlation function itself in the, so I'm using SL function to see whether I'll get the same figure. So correlation here, then I pick the array again, and then the second array, I change this D to E so it can capture the market as well. So when I now apply my brackets, I get the same thing. You see the one I computed using the formula below and the one using the SL, they all give me the same value. Well, that's correct. Correlation is not affected by those kind of stuff. So because of this correlation between them, it may imply a lot of other things that I'll be covering, right? Good. So we have succeeded in calculating equity risk premium, and that is what I want to do. So my first task for the day is over. Let's proceed. But one thing I want to say is that I use a 10-year period. Those 10-year period may not cover the entire equity market or equity risk, or right? Because equity is a long-term investment, so may not capture the entire equity risk. There are other methods. Then there are estimates done by Damodaran and Co on their websites that you can use. The reason is that he has done it over a longer period, but you can do the same thing, right? He has done it over a longer period, but what is regressing against, sorry, what is using the computation of the, let me see this. No, okay, I'll get back to that. But Damodaran has done that. The time period he used, I don't know whether it is 100 years, is 30 years, is 40 years, and all that. You know, in that case, it captures a lot of periods where even stock market crashes and all that, right? He has covered all that stuff. I believe you considered those things. Maybe I can use 30 years or 40 years to measure. Well, I can do something like that. Maybe you can try that on your own and use that as basis for your equity risk premium, right? So you subtract the 10-year risk-free rate from it, and that becomes equity risk premium. All right. Let's go back to there's no question there. Let's go back to what we have been doing and see. So we have done that now. Let's move forward to estimating beta statistics. Now, so what is beta here? If you look at the equity or the general equity return model, which we looked at earlier, the cost of equity here is equal to the risk-free rate plus an equity risk premium. We talked about this yesterday. Now, we have succeeded in estimating appropriate risk-free rate and expected equity risk premium. We have done that. Congratulations to us. We have done that. Now, here, expected return for an average stock in the S&P actually makes the CSRP equal to 0. In other words, what I'm trying to do is that let's take it this way. If you take the S&P, consider S&P as the average return of all the stock that are considered constituents of the S&P, the average return on them. If that's the average return, and we are saying that the S&P has no company-specific risk. In other words, it's a well-diversified portfolio such that the only risk associated with S&P is a systematic risk. If that's the case, the company-specific risk premium is 0. In other words, the equity risk premium will be entirely driven by the market. Okay, so the kind of broad-based index that helps us to do that is the S&P, and I explained that. But there's a problem. The problem is that the companies whose returns we want to estimate are not of this average risk. They have elements of company-specific risk and all that. That is one. Beyond the argument of company-specific risk, these companies also may not be of average risk compared to the market. So they may be riskier than the S&P 500 as a whole as a portfolio, or less riskier than the S&P 500 considered as a single portfolio. Is that okay? So because of that, if you just use the return on the S&P 500, you can't just say that that will be the return on a certain or a specific stock, because that stock may be riskier than the S&P 500. Now, a lot of things I'll be saying today, I should have been taking a longer time, period to explain, but because of limited time, I am going to go deeper. However, how I would have loved to do this, maybe in a setting where I have a full week to talk about equity risk premium, I may not be able to do that to that extent, right? But bear with me, I'm going to explain all that. So beta is that statistics that help us to adjust the market premium to compensate, or maybe to adjust the market premium such that the cost of equity you'll be calculating for the company in question is consistent. In other words, if the market premium, what we have just calculated, equity risk premium, we have calculated for S&P, that's what we call in the market premium. That which we've calculated around 5 point something, and that is the market, the equity risk premium. That equity risk premium, if the company whose cost of equity you are trying to estimate is of a higher risk than that market, then that company will tend to adjust that S&P equity risk premium up so that it gets its own risk. Are you getting the point? Compensation. If the company is of a lesser risk than the S&P 500, then it's going to adjust that S&P 500 equity risk premium down to get or to arrive at its own equity risk premium. We're going to go through that. Now, there are two ways to handling the estimation of the beta. The beta helps us to do that. There are two ways to estimating the beta. We have the statistical method and we have the fundamental method. The whole idea is that the statistical method is based on the normal regression we do. We regress the stock data against the S&P 500 index for the same period. The fundamental beta is telling you a question, is asking a question. Look, what are you interested in? You are talking about risk, right? How risky the company is compared to the S&P 500. Then if that's the case, then why won't you consider the fundamental issues associated with the company rather? Whether so get to the fundamental matters like the business model of the firm, the leverage the company is taking and all that. Why won't you consider that? So the question or the whole advice here is that when we think about beta, you must think in fundamental terms. Now, so when we are estimating, we want to start the argument by first estimating a statistical beta. Once we estimate the statistical beta, we are going to transition from there to estimating the fundamental beta or an appropriate beta that we will be using in our equity risk model. Now, I want to show you something. As I mentioned earlier, this model you are seeing here, the cost of equity model, which is the risk-free rate plus equity risk premium. I told you, this is the model that anybody will use for the S&P 500. So if you take S&P 500, for example, this is the model for S&P 500. And I'm saying that the risk-free rate is independent. It is here. It doesn't, no risk affect it. There's no risk affecting it. Like it has no correlation with the market, right? The risk-free rate has no correlation with the market. So the only thing that is a source of risk here is the equity risk premium, which is a compensation for risk. So this simple model here is the model for the stock index. So if you want to determine the index return, it's a matter of the risk-free rate plus the equity risk premium on the index. That is the reason why in formulating capital market expectation is more of what will be the equity risk premium on the index, because we can actually forecast the risk-free rate. So it's a matter of what is the equity risk premium on the index. Once we get that, we can forecast the return on the index. But I'm saying when we are doing this at the level of the company, then this equity risk premium can be adjusted up or down depending on how risky the company is compared to the S&P 500. And I said that the tool we use or the factor we use to adjust this is called the beta, right? Good. Now, as I mentioned, the computation of the beta statistically is very easy. All you do is to do a simple linear regression. So we are going to regress the return on the stock against the return on the market. Now, the return on the market, or what we consider the market here now, is the S&P 500. And guys, don't forget, we are still operating as though we are in the United States. We are working in the United States. We are doing this for a public company listed on the stock market. We're trying to calculate the cost of equity of a public company listed in the US, on the US stock market, or the New York Stock Exchange, which is called NYSE, right? Good. Now, the regression equation is of this form. This is a regression equation. The stock return, in this case, the stock we are working with is the JP Morgan Chase. The JP Morgan Chase return is equal to the alpha. You know how when you come up with a regression model, you often have this alpha hat plus beta hat, then the return on the market as the independent variable. So return on the stock is the dependent variable, return on market independent variable, plus an error term, right? An epsilon. So this error term here, I'm going to explain all these things in a jiffy. Now, the reason why we put this hat here is often when we use like the data I'm using is not sufficient. So it's more of like a sample data, right? So when you're using sample data, you are estimating the alpha, but a true alpha may differ from the alpha you have estimated. Or in other words, if you are to use, let's say, 100-year equity data, the alpha you may end up getting from the regression output may be different from the alpha you estimated based on just a 10-year data. So this alpha is an estimate. And you know this alpha is an intercept on the y-axis, right? We will look at it. Same thing applies to the beta as well. The beta is the beta we've been talking about. But statistically, we are trying to estimate the beta, which is the gradient or the slope of this equation we have here. Now, this beta 2, if it's a sample beta, or we have estimated it using sample data, if we are to use population data, the beta we may end up getting, for example, we are using 10-year. If we get a certain beta, then what if we use 20 years, 30 years, 40 years, 50-year data? Will we have the same beta? Okay, so if we use a population data, the beta we may get may be different from this beta here. Now, all those differences that are resulting in our model not correctly predicting the return is corrected using the epsilon. The epsilon here, the error term here, is the residual return. In other words, if I use this model to calculate what the return should have been, and I compare it to the actual return, I'll get the error term. We'll get to this in the Excel soon. Now, let's look at some few things. We're going to go back to the Excel, but before we go, let me say something small. I think, why should I say something small if I can just go to the Excel now? I'll show it to you in Excel, and after showing it to you in Excel, then we will then come back to the PowerPoint again. Then the PowerPoint will become clearer. So we're going to do some few stuff here. I want to quickly move, maybe move this to the right a bit. I'll move this to the right a bit. And we're going to do some few work here. We will do some work. What I want us to do is to do some regression, right? We know the regression equation at the end of the day, so we are trying to estimate beta. All you need to do is that there's a function in Excel called linest. So linest function, so that's linear estimate, right? Linest function, I come to linest function, and linest function is asking me some few questions. Put in your known y's, and that's the function I'm using to do the regression, right? Put in known y's and put in known s and all that, right? So I've copied those things already. So is this my known y? Yes, the dependent variable, which is the y variable here, is the stock return. So I have that here. I need to put in my known s as well, which is the independent, which is the index return. So we have the e, and then we have this also here, bracket close. Then it's asking me another question that, do I close the bracket? No. It's asking me another question. Do you want constants? I say yes. So that's going to be a true statement. And also, do you want further statistics? For further statistics, not really. I don't want further statistics because I don't want to get into the anatomy of linear regression. I don't want to waste my time on that. So let's hit enter. And when I hit enter, this is what it's giving me. But I'm thinking that maybe let me change it to true so I can have something here I want to show you. True. Then it gives me all these statistics. Now, these statistics is giving me, there's an interpretation to them. You may have to go online to get the interpretation, but let me just help interpret them, okay? I want to create further space. There is a reason why I'm doing this. So I will say this is the linest output. This is the linest output. Let me put that here. The linest output is here. This is the linest output we have. And the output interpretation, the alpha is this that we have here. This is the alpha. of the equation, and then the beta of the equation, of the linear equation, is this, which is this one. This is the beta of the linear equation. And then also we have the R squared. The R squared of the equation is this. The R squared tells us about how good the model is, right? The model is 52% accurate. The model is 52% accurate. That's interesting. We have our alpha here. Alpha returns. Then we have our beta here. Now, the alpha is the intercept on the y-axis when we plot this line. Now, what we are going to do is that we are going to use this model, the model here, alpha and beta here in the model here, and we use that to predict what the return should have been, right? You use that to predict what the return should have been. So let's look at that quickly. So what should have been the return? So I'm going to call this y estimate or return estimate. So I want to see what the return should have been if I use the model rather to predict. So if I use the model to do some back testing on the data, I am going to do the alpha and I'm going to log the alpha. I click F4 plus beta. I'm going to log the beta as well. So I'm going to click another F4 and then I'm going to multiply the beta by the return on the S&P, which is the independent variable here. And that is all. That's the model. You forget about the error term. I hit enter, then I drag down. Now, apply my percentage to this, and it gives me the estimated return. Now, the estimated return may be different from the actual return. So we need to calculate what we call the residual return, what is left over. The residual return, I'm taking my time to do these things, guys, because there are stories I want to tell you. And if I don't do these things, I'll be telling you the stories in vague. You may be listening to them and they may be sounding theoretical to you. So I am doing these things so that you know exactly what those things mean when I start telling the story. The residual return will be what the actual returns are minus what the model predicted, what the linear regression or the regression model predicted. That is the residual return. Okay. Now, that is residual return for you. And one of the assumptions, I think I have a question here before I talk about, means the R square part. Oh, well, the R square tells us about the fitness of the model, like how's the quality of the model in terms of the predictability, the explainability of the model, whether the model is able to fully explain the dependent variable. Let me explain what that means. So we take the linear regression model and we are applying this to we want to use the S&P. Based on S&P, we want to, and the JP Morgan stock price, stock returns. We want to be able to come up with a linear model that predicts the returns on JP Morgan. So once we know the S&P 500 return, we can predict what the return on JP Morgan should be. So we use historical prices, and out of that, we come up with the historical daily returns, and we use that to build the model. When we build the model, we want to see how strong the model is. What is the quality of the model? Is the model strong enough to predict or help us predict? And they say, well, the strength of the model is 52%. The model is able to predict 52%, or in other words, the JP Morgan stock returns, only 52% of it is explained by the stock market. Maybe, and in that case, 48% is explained by other factors other than this. But think about it, this is statistical, right? Mamle said, I'm a bit confused about how you were able to tell which of the output from Linus function is alpha. Oh, of course, out of experience. I've been doing this over and over, so out of experience. But you can go on Google and do that. Google will show you the various positions. The first one is beta. The second one is alpha. Then this one is, I know their positions, right? You can do that in Google. Asking for the interpretation to the output of the Linus function. Now, we have the residual returns here. With the residual returns here, I want to show you one powerful assumption made by the linear regression model. I want to show it to you. Please reiterate the formula for the return estimate. The return estimate is basically the linear regression model. The alpha plus the beta times the independent variable, like a linear equation. The intercept on the y-axis times the slope, or plus the slope times the independent variable, right? Is all, in other words, you are calculating y, and you say y is equal to y is equal to b plus as, or y is equal to a plus bs. That's what is happening here. Now, coming here, now we've gotten a residual return, but there is a very powerful thing I want to explain to you as far as linear regression is concerned. Think about something like this. Let me calculate the average of the residual. If the average of the residual are not zero, if the average doesn't sum, or I don't get an average to be zero, then my model is wrong. My linear regression is wrong, and I can't use it to do any work. The average of the residuals must be zero. And I'm going to emphasize that point in the lecture notes. So the average of the residuals must be zero. And then I can move this onto the residual, and I want the average to be zero. And I want to get it. Let's see and see. It is not zero. So it tells us that there must be a problem with how this is being estimated. I have all my points here. How can I get this not to be equal to zero? It has to be zero for a linear regression to work. Oh, I think there's a problem. I don't know if I'm coming. This thing keep freezing every now and then. Okay, so I have my model. So my model is correct. So I need to be able to have that. Just a moment, guys. So I have my stock returns minus the estimated returns, which is a residual, which must be zero for the regression to work. Here is not zero. The average is not. Oh. Oh, I think my network was off a bit. Please, how did you come out with residual? Oh no, residual is basically the stock return minus the return estimated. So what the actual return is minus what is estimated by the model. I'm coming, let me see something. Let me start with this first. Oh no, I'm doing something wrong. The average must be zero, because if the average is not zero, then we have a problem. The average at all time must be zero. Let me see a question. I'm not sure why you use the stock return as the independent variable when calculating the predicted value. Should the independent variable not have been the market? Did I use the stock return? I doubt if I do that. Oh, I use the stock return. No, thank you very much. I use the stock return. Oh, it's supposed to be the index, because we've always said that the independent variable is the index return. I was just using, that's the reason why I didn't get it, right? Thank you very much for that. Who said that? I use the stock return. Thomas, thank you very much, Thomas. So I mistakenly used the stock return. So got that corrected, and then it must be zero. Have you seen it now? It must be zero. So we have it being zero. So in this case, we can use this regression. Otherwise, we will not be able to use it. So now I have it zero. Thank you very much. I made a mistake, and that got corrected. And that was a very great one. Now, one thing I want us to do, now that we've gotten this, let's also calculate another statistics. Now we've gotten the let's say the mean, let's call it the mean of residuals, or mean residuals. Let me just call it mean residuals. And the mean residual, we had it to be to be 0. So the average of the mean residuals is 0. So that is the first one. I want to also calculate the standard deviation of the mean residual. And so let me call that the standard deviation of the mean residuals. The standard deviation. There's a reason why I'm doing all these things. This class supposed not to have been this kind of topic, but we need it for something. So I've calculated this and I've gotten 1.2, but this is a daily figure. You'll see the same thing appearing in the linear regression model here, the Linus function, right? The Linus function output here. You see that here, 1.2 as well, 1.2. This is called the standard error of the regression. Just call it the standard error for now. So this is the standard deviation of the errors associated with the model. In other words, it tells you how wrong your model can be or how wrong your estimate can be about returns. So that model you build to predict the return on JP, it tells you how wrong those can be. But this is on a daily basis. So you multiply by the square root of time. And then that is to say, you multiply by the square root of 252, and that gives you 19.9. So the standard error is 19.9. Of course, that gets used in a lot of things, right? But we're not trying to cover all that. But there are two things I try to establish here. The item number one I try to establish here is that the average, the mean of the residual is 0%, and the standard error is 19. Now, the standard error, when we're doing portfolio analytics and want to decompose portfolio risk, the standard error is the source of the idiosyncratic risk. Or in other words, the standard error here will help us to measure idiosyncratic risk associated with the stock. Sorry. So a standard error of 19, good or bad? Well, it depends. It depends. It tells you about the amount of idiosyncratic risk. So the one idea is that you are using this, you are looking at this standard error, and also you are looking at the excess return associated with the stock. If I say excess return, now I mean the alpha. You are looking at the alpha, you're looking at this standard error or this measure of specific risk, right? And then you can take the alpha and divide it by the standard error. And then you can compare that across. You can compare that across. And this has a relationship with what we call the information ratio for portfolios, right? There is an advanced aspect to this where you can actually do this risk decomposition. And that is more advanced than what we're coming to do and or what we are doing. And later sessions, maybe one day I can run a webinar on that. But you can use it to, evaluate multiple portfolios to see which one is better, right? But that requires some advanced knowledge in linear algebra. Now, we've estimated this. Now, the question is, this beta we've estimated here, there's another way we can estimate it. We can use a function in SL called the slope function. So we can do that to calculate beta again. So we just say slope, and when we take these, the known y's, this is the y, and then we also get the known s. Let me shift this to this side a bit. The known x as well, which is this. And then we have known y? No, I think there's a misplacement. So I move this rather here. I move this rather here, and I move this here. Yeah, so I got the same thing. So if you look at the beta I've estimated here, this is the beta produced by the Linus function, and this is the beta calculated by ESA function. And I want to use one more methodology to calculate the beta. The methodology I want to use is this. Earlier, we calculated some portfolio statistics. Let me bring that closer now. portfolio statistics. Let me bring that closer now. Let me move that closer. So delete. I think I can delete the entire this thing here. So let me delete the entire row. So I've moved this closer now. So this portfolio statistics we've calculated earlier, we can use it to calculate our beta now. So the beta can also be calculated using, so I want to call this calculation. The beta is also the covariance between the asset and the index divided by the covariance between the asset and the index divided by the variance of the market. So we know the market volatility being the annualized volatility of the market being and don't forget the covariance we are using to is on annual basis, right? So the volatility too must be on annual basis. So of the market is 18%. And if we are moving from standard deviation to volatility, from standard deviation or volatility to variance, we square it. So I square that return, and that gives me 1.1. And you see, that's another way of calculating beta. So there are multiple ways of calculating beta. There's another way where you take the correlation and multiply it by the volatility of the stock divided by the volatility of the index. That's another way of calculating beta. So there are several ways of calculating the market beta. Now, but you agree with me that in all this calculation, I'm using a 10-year data. If I tend to use 15-year data, would the beta be the same? If I use 20-year data, would the beta be the same? If I use 50 years data, would the beta be the same? Now, because of some issues with that, so you may have beta that is not stationary. We expect the beta to be stationary, right? That's the reason why equity, we tend to favor longer term, right? There is a related term around these residuals. If I take the standard deviation of this residual around, if I take a sample across this residual and I calculate the standard deviation for various samples, I expect that the standard deviations, if I pick samples across, I pick different samples, I expect the standard deviations to be similar, or in other words, to be constant. And that is what we call homoscedasticity, right? If it is not constant, then we have heteroscedasticity. Once we have heteroscedasticity, it becomes difficult to do some things. But however, in high levels of statistics, a lot of things can be done about that, right? Let's go back to the PowerPoint now. Someone said, although it's good to get uniform variance for the residual, is it necessary to check for the other assumption of linear regression, autocorrelation, etc., when estimating beta statistically, or you can just proceed without caring much about the other assumptions? The whole idea here is that for me, I will not want to care much. Why? When we look at the normal distribution, one key assumption we make is that the returns are independent. The daily returns are independent of each other. So that autocorrelation, we don't expect it in the returns. It doesn't mean there may not be autocorrelation. Okay, so that's the reason why when we see this autocorrelation and all those other characteristics, the manner in which we estimate volatility or the volatility updating model then get revised. Of course, you tend to see the GADs, the C GADs, the T GADs, and the E GADs, the arch family being used and all that. But here, the basic assumption I want to make here is that the returns are independent of each other and there's no correlation between them. And we may not be too wrong. We may not be too wrong with what we're doing. And again, to say, if we are working with risk, if we are trying to do risk management, we will be so much concerned with auto-regression and all that, auto-correlation and all that. But for valuation purpose, we can stick with a normal distribution. And so we can stick with a normal distribution as far as valuation side is concerned. And I think that should be fine with us. We don't need to get into those other matters. Getting back to our model. Now, I did something in Excel. I said that if we then just use this model, the alpha hat, can you see my PowerPoint? Is it visible? Please, someone should put something in the chat to signal that it's visible. Okay, good. Now, coming back here to the model, we have the alpha hat and the beta hat. These are estimates, and that's what we did. We estimated the alpha, we estimated the beta. Now, then we multiply the beta by the market return, which the index return. I made a mistake. I selected that of the stock, and my model didn't work. Now, if we didn't, or if we, and this is what we did, and this part, the alpha hat and the beta hat is market return. This part is the one we call the predicted return. This will give us the predicted return. So what did we do? We took the predicted return and we took it out of the actual return, which is the return on the stock I. We took the predicted out of it, and that gave us the error term. In other words, if we don't add the error term to the predicted return, we cannot get the actual returns. We cannot get the actual return. If we don't add the error term to the predicted return, we cannot get the actual return. Now, however, we also looked at something. We took the average of the error terms. When we took the average of the error term, it gave us 0. The average of the error term is 0. Now, that is very important. If we can see that the average of the error term is equal to 0, then we have something to do, or we have the opportunity to do something. Look at this way. Average is the same as what we call expectation. Let's take expectation, one measure of expectation being just the simple average, right? So if we say average, it means we are taking expectation of the return. If we take expectation of return, this will happen. If I have an equation, there are a lot of things that, because I'm not writing, I have to struggle to summarize them here. If I take expectation of every item here, this is what I'm going to arrive at. The expectation of the alpha hat is alpha. The expectation of the beta hat is beta. The expectation of RM is expectation of RM, ERM. It's clear here. Now, the expectation of the error term is 0, because the expected is more of like the average. The expected value of the error term is 0. In other words, the average error term is 0. That is a classical assumption in a linear model, right? Now, given an unbiased regression model, a regression model that is unbiased, an unbiased regression model is a regression model such that the expected, or the sample alpha, or the alpha calculator using the sample data, and a beta calculator using the beta the sample data with this hat all showing that they are sample statistics, right? These estimated variables will approximate the true population alpha and the true population beta respectively. So when we calculate the true population alpha, the statistic, or sorry, we call the statistics, we use the word statistic for sample. The sample alpha will be the same or will be equal to the population alpha, and the sample beta will be equal to the population beta. If that's the case, then we say the expected value of that is alpha, and the expected value of beta hat is beta, and the expected value of the error term is 0. Therefore, the expected value of the stock return, or the expected value of the return on the index, or the expected return on the index is done, or is expressed like this. So we have this equation being the expected return on the index. And going forward, this is the equation we are going to be using. That's how come the error term vanish. Remember, we've not started talking about capital asset pricing model and all those kind of things. We've not started talking about them yet, right? Let's proceed. Now, we already talked a lot about the regression equation, right? And I told you that the alpha there is the return that is not correlated with the market. The correlation of the alpha with the market return is 0. Okay, the alpha is not correlated, and the alpha here is more of like the residual return. Let's consider it as the residual return. Sorry, let me not call it the residual return, but that's that constant return that doesn't change. The standard deviation of the alpha is 0. Okay, and I kept telling you that the alpha doesn't correlate with the market. These are hard statements I'm making. The alpha, there is no correlation between the alpha and the market. The reason is that in calculation of the correlation itself, correlation is basically the covariance between the two, between the stock and the index divided by the variance of the market or the index. So if there is no covariance between, or the covariance between the alpha and the index is zero, then it means that the correlation must also be zero. And the covariance is zero because the alpha doesn't change. Because alpha doesn't change, its covariance with the market is zero. Okay, so its correlation with the market too is zero. So it's not affected by the market. Okay, now, but you are taking on a certain risk called the idiosyncratic risk. That risk you are taking, the compensation you are getting is the alpha. Right? Now, we will put it there. We will leave it there for a moment. We will get back to that again. Right. Let's continue. The beta measures the systematic risk inherent in the stock. Now, so the whole idea about beta is how much systematic risk does the stock have compared to the market. So we don't start by calculating the stock's own systematic risk. We start by looking at the market and then look at the stock in relation to the market. That's what we do. Now, I used some formula earlier in the Excel, and this is what I produced here. So you see I calculated the beta as a covariance divided by the variance. And also I calculated it again because covariance is correlation times the volatility of the market and the stock divided by the variance of the market. And then if you solve this, you cancel one sigma with the other sigma at the top, you are left with the beta being the correlation times the volatility of the stock divided by the volatility of the market. And I stated here that you can also use the slope function in Excel, and that will give you the same value for beta. Okay, now, but there are issues with the use of the regression to estimate beta. Because I told you it's about the period covered also. Because if you are using, let's say, 50 years, 30 years, you may get a different beta. Number two, the index use. I'm using S&P. A lot of people use S&P, but most people on the market use S&P. But what if somebody decides that his appropriate index is the Dow Jones, or appropriate index is the Russell 1000, Russell 2000? Will the person get the same beta? Not really. And also the basis of return calculation. I have calculated the returns daily. Someone may do return calculation weekly. So at the end of the day, the beta arrived at may differ from the beta I have. So these are challenges. So you'll see that the beta we've used the linear regression model to do is purely statistical, and it may come with standard error. And that's what we saw. We saw standard error about 19%. Okay. And even if the standard error is low, and we even have a very high R square, even in this case, the standard error is relatively high. Because if you look at the R square is very low. It's about 52%. There are several people or several analysts who have said a 52% explainability, and some may not accept it. But then it tells us that other factors may be explaining return rather than the market. And so that's why multi-factor models may be used. I mean, you may be trying to now use multiple regression for some of this analysis, right? So the beta may still be deceptive, even if the R square is very strong, and even if the standard error or how the measure of how wrong you could be is very low. It tells us that this is purely a statistical exercise, even though so it has some limited, point. But then we can still use this regression beta and build upon it, and that is what we do. Now, how then do we improve upon regression beta? The objective is that, number one, any improvement we give should be able to lower the volatility of the error term. And that's what I can see here. This volatility in the error term, the top right corner of my slide, we want to be able to lower that volatility of the error term. And the volatility of the error term is what we call the standard error of the regression. And with that, what we saw to be, I think, about 19%. We want to be able to lower this. But that is not the end. We also want to ensure that we account for company-specific nuances, right? And so some few things we can do is this, and I want to follow from here. We want to reduce the noise in the data because we may not be using a longer-term data like that to come up with an appropriate beta. So what we can do is this. We take the company whose return we want to calculate. Like we are trying to calculate the cost of equity for. And don't forget, we are still in the United States, right? We will pick the company. And then we will look at the various markets the company operates in. The company may have multiple products that may operate in different industries. So we come up with various industries, the industries they operate in. Maybe they have product A that is in industry A, product B that is in industry B, product C that is in industry C. Then we look for companies listed on the stock market for each of these industries. Then for each of these companies, you estimate their betas. We estimate the beta and come up with the average beta for each industry. We'll come up with the average betas for each industry. And then the next thing we'll do is that after coming up with the average betas for each industry, those betas, by definition, may be leveraged because the companies in question may be using debt and equity. Ladies and gentlemen, I've not started talking about issues of commercial bank yet. So the companies in question may be using debt. So because they are using debt, the betas may be leveraged. So we need to unlever those beta. When we unlever the beta for each of the industries, peer groups we have come up with, then we'll get the unlevered beta for the various industries or segments where the company's product operates or are traded. Once we get that, then we'll then ask ourselves question, what percentage of the company's business is in industry A? What percentage is in industry B? And what percentage is in industry C? Then we use that as basis to come up with the weighted average unlevered beta. But and also when it comes to the weighting of the various betas, as far as the percentage of business, we often use the cash flows, right? The operating cash flows that a company generates, operating profit, so that we consider also cost implication. Operating profit that a company generates in the various segments. And oftentimes, some companies do segmental reporting. So listed companies do segmental reporting, so you can get some of this information from the annual report. So once we get that, we use that to weigh that to get the weighted average unlevered beta. Then we'll now ask ourselves, what is the leverage of this company? What is the debt to equity ratio of this company? That's what I mean by leverage. Then we use that to leverage the beta up so that we will get the beta. And that is the beta we use for our work. And that's the beta we call the peer group beta. And that is what we have to use. And that becomes the fundamental beta because it takes account of the company's own situation, the industry circumstances, and also the capital structure matters of the company. Very, very important. So that is called or how beta should be estimated. You take the statistical, then you make adjustment to the statistical to improve it so that you get the one you really need, right? Good. Now, will you have to do all these things? Maybe not, maybe not. And I may be showing you what to do, right, later. Well, the first part has been a roller coaster. And I know it had not been easy with several people, if I should say. Maybe put something in the chat. I saw the numbers declining over time. It's not easy, really. I put something in the chat. Let me know your thoughts. So far, so good. I know things are getting tough and tougher. But I think going forward, things will be smoother, right, than what we've seen so far. And I'm going to explain a lot of things that you have been reading in your textbooks, and you now see them in full force here. Any question? Any question? Let me see something in the chat. Are you okay? Is the pace fine? Are you okay with the pace? Are you okay with the pace, please? I want to see one or two comments for me to on we go, Lodina. I love that. Yes, pace is fine, but it's a lot of information at once. That's true. Why do we really to do this part? Why do we really no let me not say you are not supposed to do it, but this is what I do. I want to understand how things are done. So even if there's a database I can pick information from, at the end of the day, I understand why I'm doing what I'm doing, right? And I can explain it. That's the most important thing. You don't pick things from places that you can't explain. You have to always be capable of explaining things when you pick things from places. We've been talking about S&P 500, and you might be wondering, glad there's gonna be a recording on YouTube. The information is a lot. The recording will be helpful. Great. There's recording on YouTube. In fact, it's live on YouTube, right? Now, there are issues with the GSE index. And yesterday, I mentioned something in relation to that. I was telling you that there are some few matters with or issues with the GSE index. Why? I don't think the use of GSE index is good at all for the analysis we are doing and why we are taking things from a developed market. And someone asked me to explain why I think the GSE index is not appropriate. And I mentioned that I'm going to do that today, right? So let's get into it. Issues with GSE, CI, and local bank stock data. Just a moment. Let me grab a glass of water. A moment, please. Okay, I'm back. So let's get into the GSE matters. Let's look at it. You see, I placed here just some few arguments. There are a lot I could talk about, but just some few arguments here, right? Now, so why the GSE is not an appropriate index to use? So the first argument I want to make is around long-term historical data. So long-term historical data captures diverse economic cycles, hence reducing estimation errors. You see, the use of shorter-term data is not advisable because equity is a long-term instrument, right? Let's look at arguments around S&P. 60 plus years of reliable data since 1957, right? Since 1957. And so that's when the S&P 500 was created, 1957, so 60 plus years. It includes several recessions, 3 major crashes in the United States, including the famous 2008 financial crisis and multiple bull markets. So it captures a lot of nuances in the economy, right? For example, the 2008 crisis showed how banks behave in systemic crashes and critical for beta estimation. And we really want to have this captured in the beta, right? And survivorship bias is also minimized because the index is still accounting for I mean, when you take that long-term perspective and all that, you always go back. It accounted for failed companies like Lehman Brothers and has given a truer risk picture, right? With S&P. When we come to the GSE, the stock exchanges had been in operation less than 30 years, or maybe, less than 30 years. Should I say less than 30 years? I think, no. It's more than 30 years, in 1989, right? But the index has itself created around 2010 or something, far less than 30 years. It misses the pre-liberalization economy and the early banking crisis of those times and all that, right? A lot of those things were missing. Those times, S&P 500 was there and since 1957, but look, the GSE index wasn't really there. Inconsistent methodology also, the index composition actually changes frequently. The delisting, UT Bank and all those things that collapsed, all those banks that collapsed affected a lot of things. So see, there are a lot of issues here. We don't have enough data on the index to form a capital market expectation. We don't have enough data, okay? We don't have enough data. Now, the next thing I want to talk about is that the S&P, I think my labeling 1, 2, 3, whatever, a lot of time, because of time, putting together these slides, you producing things from your mind and doing research at the same time. If you're not careful and you're under pressure to get this done quickly, right, it involves a lot of work. Now, so the S&P 500 reflects two market risks because it's highly liquid and diversified. Now, so the GSE index actually, with this thin trading and sector concentration, distorts risk estimate. Let's look at it. So that's the second preposition I'm putting forward, the hypothesis, what it says. Now, if you take the S&P 500, it's composed of 500 highly liquid stocks in the United States. And the trading volumes are high. Think about Apple trading volumes and all. Prices update in real time, reflecting a true investor sentiment on the market. S&P 500 because there are several derivative options, derivatives that are written on S&P 500. So, like, it's extremely liquid, very, very liquid. The slightest change in the US economy, the S&P 500 starts reflecting because people's options and things that will be, people will be trading options and the high frequency traders and all that. Like, there are a lot of analysts that are using machines that are tracking the index. So the index is always or is mostly liquid. Now, diversified sector exposure as well. So the S&P 500 has 500 large companies in the United States. And when I did a calculation, only 4.2% of the S&P index is made up of banks. In Ghana, it's about 27% of the GSA. It's made up of banks. So you see the dominance when it comes to the Ghana market, the banks are dominating it. So they are going to dominate and they are actually going to render the beta not quite relevant, right? Now, so why does this matter? So it matters because the banking heavy indices overstate systemic risk for non-bank valuation. So if you are coming to do a valuation on maybe a company like MTN or maybe Fan Milk, and you want to use the GSE, because majority of the companies in the GSE are banks, what is going to happen is that the index is going to reflect the movement in the banks. So it may not give a correct price for risk as far as your company is concerned. So the market is not diversified. The stock listed on the GSE or the GSE index is not a diversified index. So since it's not a diversified index, you will even see elements of idiosyncratic risk there in the index. You see, though you see this kind of idiosyncratic risk or sector-specific risk reflecting in the index. Meanwhile, those sector-specific risks should have been fully diversified away, right? Coming to GSE, as I mentioned, only 30 stocks. Many are illiquid. In fact, we have a lot of zombie stocks on the Ghana Stock Exchange. Some trade once less than a week. I mean, ADP price have been constant for God knows how long, right? And the stock prices here actually overstate the volatility. They understate the volatility because the stock is not trading. The share price is not quite changing. So when you calculate volatility or the standard deviation of return, it looks very low. You may think volatility is low on the market. It's actually understating it. And we know that in the computation of the beta, volatility matters. And we know this because beta is a covariance divided by the volatility of the market. The variance of the market. So if volatility is low, so it's going to affect the variance on the market. And the covariance will be affected. In all these cases, what it tells us is that the beta will be understated. So beta is going to be understated when you are calculating beta. It looks like nothing much is happening there, right? The bank dominance is actually skewing the risk. The risk is skewed towards the banking sector. And a lot of things that actually happening on the stock market, maybe if you maybe the high movers or maybe those stock performing mostly or the ones with the higher capitalization are going to be the banks because the GSE is also market weighted. So think about it. The high capitalization ones are going to be the one driving it. And if they all happen to be banks, then there's a problem, right? So it's not reflecting the true risk. The index is expected to be highly diversified such that the company-specific risk is eliminated. So no single company can dominate the index return. So the risk is diversified away. The idiosyncratic risk associated with any single stock is fully diversified away. And all that is left is the market risk. That's how the index is supposed to have been. And GSE is not such. I think there's a question. Let me address that quickly. Please explain again the second point under diversified sector exposure. So, especially the systemic risk. Okay, so the systemic risk. Think about it as the risks associated with a certain sector which doesn't get to be flowed carried to other sectors. Think about the DDP program. The DDP program hits the bank's balance sheet and the bank's P&L, but not necessarily other companies outside that domain. So you'll see that because the banks are dominating the index may be affected by the volatility in the banking stock associated with that DDP thing. Like GCB, for instance, the stock price declined significantly because of that when that was announced. Okay, because a lot of investors thought that, well, GCB has a huge government instrument. Okay, so they are going to be really, really hardly affected. So, but they're affected by the stock price decline significantly. Now, if you are calculating beta, the beta may be biased. You are trying to value a firm like FanMill, and you are using that data to calculate beta. The beta will be biased by the systemic risk in the banking sector, which really has nothing to do with what you are doing. That risk is supposed to have been fully diversified away. If it were a diversified portfolio, okay, if the index had been fully diversified. Now, another thing to talk to you about, the last argument I want to make as to why the GSE index is not appropriate. Look, the S&P 500 actually represents a broad-based economy, while the GSE index heavy bank-weighted distort risk assessment for non-bank sectors and even banks themselves. And I explained this point for the non-bank, but let's get into it again. If you take the S&P 500, the S&P 500 is a true market portfolio. And don't forget that the expectations we are forming, the beta things we are estimating and all that, assume some or have some underlying assumptions that must be respected, right? The S&P 500 is a true market portfolio because it represents all sectors of the US economy. Think about it, healthcare, financial, tech, all of that are included in the S&P 500. When we come to Ghanaian economy, tell me the GSE index, whether the GSE index reflects all the sectors. No. So the banks behave differently than tech. And don't forget about that. Or healthcare stocks during crisis. So if we have the S&P 500, it tend to diversify away the specific risk, right? So using a diversified index isolates the bank specific risk, like risk associated with the bank, like the systemic risk and all that. Now, following that, you see that it gives you an accurate estimation of beta. So the bank beta versus S&P 500 is often accurate, but the bank beta versus the GSE is often understated because the GSE is mainly dominated by the banks, and in that index, there are company-specific risks or there are sector-specific risks. But we want the index not to be sector-specific, the index to be diversified for it to be used, right? So the index, the GSE, it has two problems I want to present. The first problem is that because it is overweighted with banks, the first problem is that if the bank crash or if banks crash, the entire index crash, hence it overstates systemic risk. It's supposed not to have crashed. But if there's the bank or the banking sector crash now, the index will crash. Okay, the index will crash. It's supposed not to have crashed. It should have been in a way such that even if the banking sector crashed, the impact on the index will be minimal. That's what we call a truly diversified index. Problem number two, if banks rally, non-bank stocks look less risky than they are. And that is the whole problem here. Another problem. Now, the third problem is that there are no true market benchmark here. For example, if you look at a telecommunication company's beta, like MTN beta versus GSE, it's distorted because the banks dominate index movement. So you calculate the GSE again, regress it against, or regress MTN against GSE, and realize that you get a certain beta, and you are happy that you have calculated beta. No, that beta is a distorted beta because the banks are dominating that GSE. It's supposed not to have been so. So these are the arguments are presented for or in favor of S&P and why I think the GSE index should be placed somewhere when we're talking about beta estimation and also expectation or calculation of expected returns on a market. Thank you. Okay. I wanted to include a certain slide, but I should have deleted it. I didn't do that before sharing this. Any question? How are we faring so far? It is 7:13 and we are on it. How are we faring? Put something in the chat. Let me see something in the chat. Let me have some words from you as we go through this. I want to see if you are enjoying the lecture, if you are learning some new things. Okay. So we are following great so far, going very well. Good info on the difference between S&P and GSI, and we are here. Roll on, going on. Indeed, the GSI is not representative. Great, thank you. All right, we've been doing a lot, ladies and gentlemen, and all we've been talking about have been a lot. I think someone said following indeed Lodina, and Mamman said, so if the company we are valuing is listed on GSE, do we pair S&P 500 with the listed bank or pick a stock on the S&P? Good question. Good question. What we actually do is that we do things at the level of the industry. So we look at a company we are valuing and say, ask us, so which industry does the company fall? So if it falls in the banking sector, then we are going to look at the regression at the level of the industry. I told you that the beta estimation must be at the level of the industry. Then you include company-specific nuances, right? So we don't do it at the level of the company. That's what I told you, that if you just do regression at the level of the company, it is biased. It's statistically biased. And that's why I talked about the peer group beta and all that, right? We will be doing a practical application of this later. Yeah. And now set aside the beta calculation, all good. Yeah, I think you can listen to this later again, and trust me, you'll get a beta calculation too. So you see, we've been discussing a lot of things, but they have all been around the linear regression. I want us to now get into the meat of things. With all that we've been studying, we want to start doing the work we want to do. I took my time to explain a lot. Michael said, is there any S&P 500 equivalent in other markets aside the US? Is there, yeah, we have the FTSE 100 I think in London, another, but S&P 500 is all we all use. Everybody uses S&P 500 because how developed the US market is. Is there any S&P 500 equivalent in the other markets aside US? Other markets also have their own index. It's just like coming together, we have the GSCCI, right? But the question, everybody uses the S&P. Because of the level of diversification there. If you take the FTSE 100, it's just talking about top 100 companies in the UK, right? But with S&P 500 is looking at 500 companies in the US. Think about the number of companies in the US. US is quite a large market, right? How do we do about the GSE then? It is the market we operate locally. Yeah, that's the market we operate locally. But let me tell you this. When investors are coming to invest in the country, they don't care about the GSE market. They don't care about GSE. When they are evaluating their investment, they don't care about GSE, right? They don't really care about GSE. We don't use markets that are illiquid, isn't it? Okay, so what we are going to do now is that we are going to put things into perspective now, going forward. That's the objective of what we are going to be doing. We will put things in perspective, and what I mean by that is that we will now start calculating the cost of equity. So we've learned a lot. We will now put all of them together. We want to calculate cost of equity. I told you earlier, we're going to start this from a developed market, and then we'll move it, make adjustment, then bring it to our local market here in Ghana. Emerging markets. So we'll start with a developed market argument and we'll move it to emerging market. So let's pose the question this way. Suppose you're an analyst that work for BlackRock, or you're an analyst that work for JP Morgan, and you are doing a research or putting together a research report, okay, a research report on the equities. You'll be following the stocks of Apple, and you want to value Apple to see if Apple is undervalued or overvalued or something. You want to make that determination. Now, and so you want to calculate an appropriate cost of equity for Apple that you use. Remember, Apple is a public company. And since Apple is a public company, and luckily Apple is part of the S&P 500, it becomes easier to do, right? So what we're going to do is this. We are going to use the CAPM, the capital asset pricing model, which I believe almost all of you have heard about before. And that is the model we're going to use to predict equity return. But we're going to do the prediction for public companies in developed markets. When we are done with public companies in developed markets, then we will adjust that to get private companies in developed markets. And once we get for private companies in developed market, we then adjust that, and then finally we will get for emerging economies like Ghana. That's what we're going to be doing. Now, let's start. My screen is a bit busy here, but I have done all this for your benefit. All these are presented here for your benefit. We've been looking at a simple linear regression model, and we use the linear regression model to come up with a forecast for equity returns, the return on the stock. And so we can actually recall. So recalling the equation for expected return on the stock, which is the expected return on the stock is equal to the alpha, and I explain all these things, right? Plus the beta times the expected return on the market. So once we know the expected return on the market index, you multiply by the beta, and then we add the alpha to it. The beta and the alpha, the expectation is still the same value. So it doesn't change, right? Good. We know this, and we all remember this. This slide is very, very important. In most finance textbooks, they don't deal with this. They don't even explain. They just put the CAPM formula there and tell you that use this model. But I don't think it's a fair thing to do. And a lot of finance textbooks on corporate finance that attempt explaining this, they tend to give you modern portfolio theory, and they don't really do the connection well as to how these betas are, the CAPM arises, and also in terms of how we can take the linear regression model and then create the CAPM out of it, right? Because if you look at the linear regression model, you don't see any risk-free rate here. You don't see any risk-free rate. You see alpha. You see expected market return. Expected market return is also in the CAPM, but alpha is not in the CAPM. But there is risk-free rate in the CAPM, which is also not here. You see, and in the CAPM, how the beta multiplies the expected return is different from the way it is here. In the CAPM, we take out the risk-free rate from expected return on the market before we multiply with the beta, but here is different. And one thing also you can see that I have introduced expected symbols here. Yeah, these are very important because these are all expectation measures, right? The expected value of the return on the market is not constant, is uncertain. So it's not a constant. That's the reason why expected value must always be placed around it once we are calculating expected value of return. So people who don't do these things, that's not a proper way of writing it. So what I've done here is a proper way of writing expectation, right? Now, we are going to do something, and I want you to follow me. Let's subtract risk-free rates from each side of the equation to have the expression in terms of equity risk premium. So follow me. It's not difficult. But again, I'm going to explain to you the reason behind that, the economic reason. Okay. When I take our risk-free rates, this is a risk-free rate. I take it out of the expected return on the stock and also take the risk-free rate from the right side. So I'm subtracting risk-free rate from the left and from the right. It doesn't change anything. If you subtract a constant from both sides of the equation doesn't lag or lose its properties, right? Now, because it's a constant, I'm subtracting the same values. And you will notice that I didn't put an expectation symbol around the risk-free rate because the expectation or the expected value of a risk-free rate is still the risk-free rate. Don't forget, I explained this the very first day we started, or that was lecture 3. I explained it the very first day we started talking about discount rate. The expected value of a risk-free rate is still the risk-free rate. Why? Because for something to be risk-free, the actual return must be equal to the expected return. Therefore, expected return is the same as the actual return. Therefore, there's no expectation symbol by the risk-free rate. Okay, so this is the first one. The second one, we come here, and this is very important. And here, I need to demonstrate it to you for you to see, so you believe me. Sometimes, if they don't do it, you may not believe the individual. You need to believe me. Now, think about it this way. If you look at this, this is beta multiplied by the expected return on the market minus risk-free rate. And that is basically the equity risk premium that I borrowed from here. This term here, let me use another color. I need a color. I don't like this color. I'm trying to get a color that we use shaded glimpse and toolbar. I don't know, but I'm trying to get a good color to use here. So use my pen. Why can't the color side is inactive? No, but what you have here, oh, sorry, I didn't do it well. As I said today, please stay with me a bit and I may exceed the time so that I can finish this today. So I believe we are friends now, right? So you can be with me. Now, this portion, I don't want to rush this. This portion here is the equity risk premium. This portion here is the equity risk premium. And you know equity risk premium, we calculated it in Excel a few minutes ago. That's the return on the market minus the risk-free rate. That is what I brought here. That's what I brought here. So we can see it. And then I made an argument that this equation, this term here to the left is the same as the term to the right. What am I saying? I'm saying that if you take the beta and you multiply by the return on the market and you subtract the risk-free rate, is the same as taking the return on the market and subtracting the risk-free rate before multiplied by the beta. And I did this, and I know you'll be wondering how. It doesn't make sense if you look at it, because here, I'm taking off the risk-free rate, out the risk-free rate before I multiply by the beta. So if I take out the risk-free rate from the market, the value will be lower before I multiply by the beta, right? But here I don't do the same thing. So it's a bit counterintuitive if you look at it. But there's a reason why I'm doing this. And I'm going to show it to you in Excel. And that is the catch. Once you get it, you are done. I'm doing that because given that the covariance between the index return and risk-free rate RF is 0. If the covariance between them is 0, it means that the beta is not sensitive to the risk-free rate. And also it means that, and look at it this way, the return on the stock, or sorry, the return on the index is not entirely risky. In return, I'm taking it again. Guys, listen carefully. The return on the index is not entirely risky. There's a risk part of the return, and there's a riskless part of the return. In other words, if someone is going to buy the index, the person also have, or the person's opportunity cost may be to buy a risk-free instrument. Therefore, we expect the index to generate return above the risk-free rate. And that's why we are concerned with the equity risk premium, which is the excess of the index return over the risk-free rate. Okay, so the index return here minus the risk-free rate gives us the equity risk premium. That is the component that is sensitive to the beta. That's the component that we multiply the beta by. That is the source of risk. So in other words, the index return is not entirely risky. There's a risk-free component and there's a risky component. So and let me demonstrate this to you. What I'm going to demonstrate to you is that I want to show to you that if you take this return and look at it this way, I want to show to you that if I take the return on the stock and I subtract the risk-free rate, and also take the return on the market and I subtract the risk-free rate, and I do the regression, the beta will still be the same. But look at it this way first, because this is quite critical. I said this relationship is true. If you use the beta to multiply the expected return minus the expected return added to the RF and subtract the RF is the same as subtracting the RF or the risk-free rate from the return on the market before multiplying with the beta. I want to show you that. But before I show you, let's come to the next stage. Since I said this is the same, then I can substitute the other one rather into the equation. We're going to see so. If this relationship is the same, then I can substitute the second term that I've introduced now that I said is equivalent to this one. This one here, I can substitute it back to the original equation to replace this one. And when I do that, I get this equation below. So you remember that the left-hand side is still the same. The left-hand side is still the expected return on the stock minus the risk-free rate. But the right-hand side, I have taken away this one. In this one, where the risk-free rate has not been subtracted from the return on the market, I've taken away that one, and I replace it by the one that the beta was calculated on the excess of the risk-free rate, or excess of the return on the market above the risk-free rate. I've replaced it by it. So I have this instead here. And I said that they are equivalent, therefore I could do that. Now, how am I going to test whether I am right? I'm going to test whether I'm right in this way. I'm going to do the regression again. If I do the regression, I expect that the beta is the same. The beta doesn't change. If the beta of the regression change because of this new methodology, then I am wrong. So how am I going to do the regression? Now, earlier, I did the regression by regressing the stock return against the market return. Now, I'm going to do the regression. And I'm not going to do a full regression, guys. I'm just going to calculate the beta, right? So I'm going to calculate the beta now based on the equity risk premium, which is the market return minus the risk-free rate. I'll do the regression based on the equity risk premium here. Sorry, am I saying? Which is the return on the stock minus the risk-free rate. And I also do, and I'll regress that against the market risk premium, okay? The market risk premium and the stock risk premium. That is what I'm going to do the regression now. If this gives me the same beta as before, then I am right to say that the two are equivalent. Let's try it and see. So let me unshare this particular screen and then go and share my Excel screen. Go back to my Excel, and now I have my Excel here. So what I'm going to do now is that I have the risk-free rate already. I have my risk-free rate. Where did I write it? 10-year risk-free rate of 4.5. Let's have that. Let me paint it nicely. Highlight it so you can see. And let me delete the space here too, so that it will be closer to the data. No, I shouldn't have deleted the space because I want to do this here. So I'm going to insert some new things, right? Two types of returns I'm going to calculate now. So this will be the returns I'm coming to calculate will be, the first one will be the ERP on stock. That's the equity risk premium on stock. So stock ERP, And ERP, we know, is the return on the market minus the risk-free rate. So this one is for the stock. And then we have another one, another ERP. Let me adjust this properly. So you have another one, which will be the index ERP, which is also, I might say RM. This one will be RI. That's the return on a stock, right? So the index ERP, equity risk premium, which will be the return on the market minus the risk-free rate. So that's what I'm going to do. I want to quickly maybe do this, and let's see how it works. So I'll take the returns here minus the risk-free rate. The risk-free rate, I have it here. But the risk-free rate is an annualized rate, so I divide it by 365 because I'm working with daily numbers. So I reduce that by, I divided that by 365, so I get the daily number. So another thing is that I need to log it, right? So F4, then I have this. Divided by 365. I didn't minus, no, it's supposed not to be minus. Oh, no, sorry, it's minus. So I got it. So when I do this, then I apply the percentage sign to it. So this is what I have. Then I drag. So I drag that way, and I can also drag to my right and do the same calculation. So now, this is what I have. So this one, I'm now doing the regression based on this. If they all give me the same beta, ladies and gentlemen, if I have the same beta, then I'm done. If I have the same beta, then I'm done. Then my relationship is true. You can change that. So let's do the beta, and the beta is based on the return on the market. It's based on ERP relationship. Let's see whether that beta will be the same as this one. So what we do, to get beta, we can just use slope, right? I showed you the slope. We have the known S, which I need to copy from here. The known S and the known Y's, and then we've done a beta calculation. So we have the slope, and with the slope, the known Y's, comma, the known S. So the known Y's, the Y in this case is this one, and then the known S, and that is this one. Let's see. And I'm praying this is correct, because if it's not correct, I'll end up embarrassing myself. Let's see. I got the same thing. Guys, can you see? I got the same thing. Look at this. I got the same thing. So the beta is still the same. So it means that even if we use the stock return and the index return roughly like this and calculate the beta, it will be the same as even if we subtract the risk-free rate from each of them and calculate the beta. And there are reasons why this is true. Because beta itself, the formula for beta is the covariance between the stock and, let me show that to you again. Let me go to the PowerPoint and show that to you again. So you see why we got that right. You see why we got that right. Because if you get to where we calculated a beta, we said beta is a covariance, between the stock and the market. The stock and the market divided by the variance. Covariance between stock and market. Now, inherently, the risk-free rate covariance with each of these things is 0. Therefore, risk-free rate doesn't affect the calculation of beta, because the covariance between risk-free rate and the market is 0. Because the correlation between risk-free rate and market is 0. Therefore, its covariance is 0. Therefore, it will affect the calculation of beta. That's the whole idea, guys. That's the whole idea. Now, let me see a question here. Okay, now that's clapping. Yeah, I got it now. Thank you. Thank you for clapping for me. It's only now that clap for me here. So we have established this, and that is beautiful. But there's something wrong again. Oh, we are moving towards CAPM. What is the whole problem here? Let's check it out. So we still have the left side being expected return on the stock minus risk-free rate. But we still have this alpha. And in the standard CAPM, we know that we have this risk-free rate. We know we have the expected return on the stock. We know that we have the expected return on the market. We know we have beta, but we don't have alpha. So how can we get alpha out of the equation? Now, that takes us to finance theory again. There's an assumption here. In equilibrium, no stock is expected to consistently outperform the market. Okay, no stock is expected to outperform the market. There are a lot I can say about that, but think about it simply like this. If there's a stock that everybody considers to be generating excess returns, what do? People buy that stock. As more and more people buy the stock, what happens to the price? The price drops. So that excess return vanishes. So arbitrage, if there's arbitrage, people will take advantage of the arbitrage. So the trading activities of people and all that trying to take advantage of the arbitrage will correct all these kind of excesses on the market. So in equilibrium, and CAPM is an equilibrium model. It assumes arbitrage. It assumes no arbitrage on the market. You see, CAPM assumes there's no arbitrage. Stock prices or stocks are fairly priced. There is no stock that is undervalued. There is no stock that is overvalued, and all stocks are giving returns that lie on the security market line, right? No stock's return is above the security market line. No stock return is below the security market line. Any stock return that is above the security market line tends to be an overvalued stock and below an undervalued stock we have, right? So in that case, if we say that no one should make any profit, consistently outperform the market, then it means alpha must be zero. Because alpha tells us about whether you are outperforming the market or not. So alpha must be zero. So we have alpha being zero. Now, once alpha is zero, look at this. Alpha vanishes, and all we need to do is to move the risk-free rate from left side to the right side. And what does it give us? This is the CAPM. So we have arrived at the CAPM. All right. Now, let me see. I think something in the chat is a question. Let me clap for you two. Anthony, thank you. Now, you'll be wondering, so why did Julius introduce risk-free rates? Oh, why did you introduce risk-free? Yes, risk-free rate is not affecting the calculation, but why did you introduce risk-free rate? Yeah, I introduced risk-free rate because there is a basic assumption under the CAPM that all investors, you see, all investors are expected to hold a market portfolio. In other words, every investor is expected to bear the risks at the level of the S&P 500. Okay, because we are using S&P as the market. So all investors are expected to bear a risk equal to the risks in the S&P 500. So no investor is expected to do something different. But if you want to do something different, then either to take a risk that is above the S&P 500 or a risk that is below the S&P 500, then what you need to do, you can only leverage on risk-free rate, because everyone is knowledgeable, everyone have access to the market portfolio, and everyone can buy the market portfolio. And the demand and supply of assets on the market is in equilibrium. Because of that, there is no overpricing or underpricing. And so that suggests that if you want to take on more risk, or so let's start the argument from a lesser risk. If you want to take on a less risk, then don't invest 100% in the market portfolio. You can invest less than 25% in the risk-free instrument and 75% in the market portfolio. Your risk will reduce. Total risk will reduce because there's no risk in the risk-free, but you are taking only 75% of the risk in the market. That's one. Now, if you want to take on a risk higher than the market too, well, you can invest 100% in the market and again go and borrow at the risk-free rate and invest again in the market. In that case, you are investing, let's say, 125% in the market and let's say negative 25% in the risk-free rate because you are borrowing from at the risk-free rate. We call that the borrowing portfolio, and call this to the other one I discussed first, where you rather go and invest in risk-free instrument, and also we call that a lending portfolio because you are lending to the government. So the introduction of the risk-free rate here is so that we can take account of investors' risk aversion. every investor may vary in terms of the level of risk they want to take. They may not go with the risk in the index. They'll go with the risk higher than the index or lower than the index, right? Because of that, that's why we introduce the risk-free rate so that it accounts for risk aversion. Because this model is going to be used by individual companies and all that. They may not be investing in the S&P. Therefore, there must be a combination of the risk-free rate and the market portfolio. That's why when you look into this equation, there's a risk-free rate component and there's a component that talks about the market risk, which is the second term. Ladies and gentlemen. Any question there? Oh, we're almost done, guys. Don't think we're going to stay here for too long, of course. A lot of people who have gone to watch are watching Champions League. We're also studying, right? A lot of investors are betting on Arsenal winning. And we're also betting on Arsenal stock prices rising and using capital asset pricing model. And they're also using their own valuation models out there. We are all doing the same thing, but in a different way. We are valuing the stock while they are valuing the match. That's all. All right, so let's wrap up quickly. So we've been able to come up with a CAPM model, and that's beautiful. Didn't we do well? I think we did a good job. We're able to prove the CAPM. Okay, I didn't just come here and say, guys, this is CAPM, and that is all we use. No, I told you also how the CAPM, how the CAPM is arrived at. Actually, in fact, if there is something that beyond this that I've not explained, either you see me off this call or you send a mail to William Sharp. He's still alive today, and the professor will be willing to answer you. He developed the CAPM. Great. Now, let's proceed. Now we've calculated a CAPM. I want us to understand the CAPM further. So more on CAPM. Let's think about it. Can the CAPM be used by everyone? Can we use the CAPM for every company or any company we find? Maybe not. Let's look at it. Now, recalling the CAPM. So the standard CAPM is as follows. We have the expected return on the stock is equal to the risk-free rate plus beta into bracket expected return on the market minus risk-free rate. So we've now worked on this and we are fine now. And we know the expected risk premium, or sorry, the equity risk premium. Remember that the equity risk premium is this. And this one, you all know what the equity risk premium is. So you know that if we substitute equity risk premium in place of this term, you have the expected risk, I think I should have written this as expected risk premium, right? That's what I should have done, expected equity risk premium. You have the expected risk return on the stock being equal to the risk-free rate plus the ERM. Now, this risk-free rate here, this ERM here, which is the expected return on the market minus the risk-free rate, has an interpretation. It is the extra return you require to move your money from a risk-free asset into a particular stock, I. Look at it. From a risk-free asset into a particular stock, I. A particular stock, I, because this beta help us to adjust this ERM based on the stock we are talking about. If the stock is the market, the indices of you're investing into, which you can invest directly in, the beta will be 1. In that case, the ERM is basically the expected return on the ERP, right? Is the expected return on the market minus the risk-free rate. But if the beta is less or more than 1, then it is adjusting it in relation to the risk in that particular stock. Right? Now, that's why I make it stock I. It can be any stock at all. So any stock and its own beta. So if the stock beta is 0.8, you just take the expected risk, the equity risk premium and multiply it by that. Now, I just said that the extra return you require to move your money from a risk-free asset to a particular stock, that extra return is the equity risk premium. And a point I want to make here is that the investor we are talking about who is moving his money, the one assumption is that the investor holds a diversified investment and so is exposed to only systematic risk. Now, you realize that this is true. Why? Because there is no undiversifiable portion to this equation. You don't see any company-specific risk in this model. It is only the systematic risk. But the question then is, which investor? When we talk about investor, which investor? Is there any kind of investor? No. Investor must hold a diversified portfolio. Which investor? And oftentimes, we are talking about the marginal investors. And when we say the marginal investor, we mean the large shareholders, like the institutional investors, the pension funds, the investment bank, the asset management firms that run huge portfolios and on behalf of clients, or maybe they have their own proprietary portfolios. So that's what we call an investor, not individuals like you and I. You and I, we may not hold a diversified portfolio. You and I, we may be holding a single position, a single asset. We investing in just a single stock, or maybe we have a bit or more than 2 or 3 stocks, or maybe we can also invest in a portfolio, but that portfolio itself is a diversified portfolio in its right? One thing also is that the amounts required to even create a diversified portfolio, we may not have that amount to invest, right? Now, so we mean marginal investors. They are the ones we are referring to when we bring about a CAPM. Now, so the CAPM we have here can be used to calculate the expected return on the stock of a large company in the United States. A large company in the United States, we can use that for it, period. So we are done with public companies. Public companies, we can use the CAPM, period. Any question? You now move to private company. And now it's going to be faster because moving from public to private is very easy. So then now we've done a lot of work. So it's about just building on that and adding some things to it, and we are cool to go. I didn't see any questions. So I believe you guys are fine. Now that we know how to calculate cost of equity for public companies in the United States, let's go ahead to calculate cost of equity for private companies in the United States. Meaning, I'm talking about more of like those companies not listed, right? To do that, let's start with some characteristics of private companies. You see, private companies, I came up with these 3 characteristics. Number one, the unique characteristic about them, like their ownership. There is one man, some of them are one-man company. Some of the owners have direct influence on the business and all that, decisions and all that, the management and all that. And sometimes you tend to have something we call key person risk, right? Key person risk and all that associated with the company. If one person dies now, or if the key person dies now, then the business has come to an end. Things like that happen a lot in private companies, right? Lack of readily available stock data. Of course, they are not even listed on the stock market. So that's another issue, right? Then the third one being limited information disclosure. Their financial reports are not advanced, and a lot of them, like SMEs, may have alternative financial reporting standards to comply with. And governance-wise, they may not be well governed, right? So those are some basic issues with private companies. Thomas is saying, if alpha, the compensation for idiosyncratic risk goes to 0. Why is value investing such a big deal? And value investors claim efficient market hypothesis is a fallacy. Oh, well, they claim efficient market hypothesis is a fallacy because even the CAPM model here may not be explaining a lot of the returns, right? That's why a lot of people move to multi-factor model. If you take farmer friends like this, you see issues of value versus the growth stocks, and you look at things like size, small cap, large cap, and or maybe you can talk about the carrot models, where you are the 4-factor models and all that to explain. A lot of these things, the arguments you can make against them, but the CAPM just made that classical maybe assumption that the idiosyncratic risk compensation here is 0, and nobody can make excess return. But people still make a huge excess return on the market, right? People still do. I agree with you. Now let's proceed. So now, because of the issues with private companies, there is a need for us to add additional premium when we deal with private companies. And there are two sorts of issues we need to look at. From the key matters we handled, we need to maybe premiums to compensate for things like the fact that private companies tend to be smaller and they suffer significantly when they are assessing capital, right? They tend to suffer when assessing capital. And they also have uncertain growth prospects, right? The growth prospect is quite uncertain, and they have riskier business operations, right? So we need to add some form of size premium to that because of the size. And the company-specific risk premium component as well. Like for key person risks, let's say it's a company that is run by the owner knows everything about the business. If the owner is no more, we have a serious problem. Even in a case where a venture capitalist is coming to buy them or another large company is coming to buy them, they may be worried about the fact that if the owner is no more there, then they have a problem, because sometimes they may even have to sign a contract that, well, when I buy this company, you are going to be there, you'll be operating a business and achieving some level of returns before we pay you the rest of the money. Governance issues, product specific issues, like think about a commercial bank having a large exposure to FS loans. So things like that means we need to add additional premium to the cost of equity. We would, so at the level of the bank, the key things we look at in the company specific risk premium. When we meet tomorrow, I think we'll solve a question on this before we start another lecture. At the level of the bank, some specific things like FS loan adjustment, maybe that you think the NPL is not good enough, is not properly adjusted. Maybe you want to add a premium to compensate for the fact that the NPL may not capture, or the ECL model didn't really capture things properly, understate risk. Or maybe you want to also look at things in terms of capital, right? Their capital is depleting. So maybe you want to add another extra risk premium. Those are company-specific matters, right? Company-specific matters, risks you can add to the capital asset pricing model. Now, so as we talk about all those premiums you can add, so we are going to use the standard CAPM again, but we're going to make adjustment. From the standard CAPM for public banks, or sorry, public companies, listed companies, this is the model we have. You see, I've now summarized it this way. I've taken out those long return on market and risk-free rate, replace it by equity risk premium, expected equity risk premium, multiplied by the beta plus risk-free rate, and that gives us this. And we are familiar with this model. Now, the standard CAPM is adjusted as follows. We take this model and we add two things. We add size premium and we add company-specific risk premium, okay, that we discussed earlier. And statistically, you can calculate the size premium. It's a matter of calculating the excess return between the small cap stock index like the Russell 1000 and the return on large cap stock index like S&P over a defined period, long term. You take that, you realize that over a long term, research shows that by farmer friends that small cap stock tend to outperform large capitalization stock. So the Russell 1000 like this tracks small capitalization stock. So in the long term, it will outperform large ones like the S&P. Therefore, in that case, there may be a size premium, and that size premium can be used. For company-specific risk premium is actually debatable as to how you do it, but here you can use your professional judgment. Another way to handle is that you can run a multiple regression or multi-factor regression model for a listed peer, a peer company as reference point. So when you do the multi-factor regression model like the farmer fringe model, instead of the CAPM, you do farmer fringe, then the alpha there you can be used as a company-specific risk premium. Otherwise, you can do your own intelligent adjustment to the alpha or to the CAPM to account for the company-specific risk premium. Now, that is it for private companies. And we are coming to the most important part, our market. How do we bring things back home? How do we bring the argument back home? Are you with me? We are having some 5 to maybe a maximum of 10 minutes to complete this lecture. I want you to type something, right? Let me know that you are with me. Let me see the men and the women that are still standing. Mamle, great. We are with you. Oh, wonderful. Wonderful. We are here. We are here. Still standing. Yeah, the last men and women are still standing. All right, good. Let's talk about considerations in the emerging market. So, emerging market situations, now we are done with everything we want to do in the advanced market. The argument is settled in the advanced market. We now want to do things at level of emerging market. Let's go and look at what emerging market story is like. Now, we want to recall something. Okay, now so just make us understand and we can stay with you. Yeah, trust me, I'm trying my best to do that, right? Now, so what have I stated here? Remember that the expected return, which is cost of equity model for developed market private companies, this. So we know the developed market. First, we know that for large companies or public companies, we have the model as risk-free rate plus the beta times expected equity risk premium, and we ended it there. And that's for public companies. And then for small companies, we added additional premium. One is the size premium, and the other one is the company-specific risk premium. So that's what we have. And we have expected return on the stock as this. So this is what we have for developed markets, private companies, or companies not listed, private company, or even small companies, so to say. Now, I am going to say something, but I think let me say it now. In case I forget, I know I've said it. Don't say that because there's a company in Ghana here that is listed on the stock market, therefore it can resemble a private company in the United States. No. What we are even considering a private company, the small company in the United States, that is even part of Russell 1000, it will be shocking to you that companies listed on the stock exchange in Ghana here are nowhere near those companies. So if we are going to assume, even though the Ghana Stock Exchange company are listed, consider them as private companies that are not listed for the purpose of the computation. So emerging markets, think about it. If there's an investor in the United States and investing in US stocks, and this investor says, well, I want to invest in Ghanaian stock, you think he will not be concerned with additional risk? What he's going to do is that he's going to do his homework and look at the return he's yielding on US stock, and then ask himself, so what extra return will I demand over and above the return on the US market? And that extra return is what we call the country risk premium. It's a premium associated with the country he's investing in. Because if he's going to invest in South Africa, the premium will be that it required on the investment in equity market in South Africa will be different from that of Ghana, and that will be different from Nigeria as well, right? So he's requiring additional risk premium, and that is what we call the country risk premium. Now, so this country risk premium actually reflects the extra risk and uncertainty related to economic, political, and financial factors that are typically higher in emerging markets. Now, I'm going to do something simply. Going forward, when I use this model, I want to drop the SP, that's the size premium, and the CSRP, which is a company-specific risk premium. I'm dropping them from the model. They are still relevant. They are going to be there. They are going to be there at the end of the day. But I'm dropping them, so I don't want to have a long model, right? I don't want the formula to be too long to be confusing. So since those ones, let's look at our main model. This is the main model. And we have the risk-free rate plus beta times the expected equity risk premium. Okay, the risk-free rate plus beta plus the expected plus beta times the expected equity risk premium. Now, from this model, we want to make adjustment, but we know that the expected risk premium here is for the developed market. It's not for the emerging market. It's for the developed market. But we need to adjust it. We need to add something to it so that we can get the expected risk premium for the emerging market, a market like Ghana. We cannot take the expected return on the S&P and end it there. We need to add something to account for the equity risks in Ghana here. And that's the country risk premium. And this is what we call the emerging markets equity risk premium model. So it takes the developed market equity risk premium plus the country risk premium, but there is something adjusting it. There's an adjusting factor here, which is the lambda, adjusting it. The lambda is going to tell you the story on the level of exposure of the company to the local country. So if the company is in Ghana here, how exposed the company is to Ghana? And maybe wondering, well, the company is already in Ghana. What are you talking about exposure? Let's think about it this way. Suppose we have a company here that registers under free zones. This company exports all its products outside the country and gets foreign currency in return. Okay. The country, this company here, let's say export products to Ukraine or export products to Russia. And then we have the Russia-Ukraine war. So that's going to affect the company. The situation in the country here may not affect the company much. The situation outside they are likely to affect the company much. So sometimes it's a matter of location as well it's a matter of the market where you sell your product than just location. Because if you sell your product here in Ghana, you are going to be affected by the demand supply conditions in Ghana. But if you sell your product in, let's say, US, maybe UK, Canada, you are going to be affected by demand and supply conditions there as well. So if you know the country risk premium, you may not just add that to the equity risk premium on a developed market to get the emerging market like that. You may want to make adjustment depending on the level of exposure of the company to the country. But as a matter of fact, what we do with the banks, it is 1-to-1. The banks have 100% exposure. So this lambda is going to be 1 for the banks. The lambda is going to be 1 for the banks. Now, the lambda often ranges between 0 and 1. So the lambda is going to be 1 for the bank, meaning the banks will have a full impact. A full impact if anything happens to the country. Will have the full impact of the CRP. The banks will do that. Good. In fact, in most work I did, I ensure that the CRP I'm using is not adjusted. Now, I think this should be the last slide, or maybe second to last slide. Now, so how then do we incorporate this? You recall from lesson 3, we estimated a sovereign default spread as the excess yield on an emerging market bond denominated in a developed market currency over the yield on a comparable developed market bond. We look at this, and I told you if the country has a euro bond, that's what we do. But if the country doesn't have euro bond, then we can use the CDS spread, okay, the credit default swap spread, or another way we can handle. Okay, so those are the 2 ways I said we can estimate the country the sovereign default spread. I think I introduced third way to doing that, to calculating that. Suddenly, I don't know why I've forgotten the third approach, but then I introduced something else like that. Now, the whole idea is that the sovereign default spread is for debt. It's not for equities, it's for debt. The default issue is debt, and equity is riskier than debt. Because equity is comparably riskier, we can take the sovereign default spread and assume that is equity risk as well. The risks here, you can think about the country risk premium as the risks that affect the general equity market in Ghana. Those additional risks affecting the equity market here in Ghana that are not captured by the S&P, because the S&P is capturing the risks affecting the equity market in the United States. So it's capturing the US level risk. So above that US level risk, in terms of US level financial risk, political risk, what is that extra yield, or extra risk that is being faced by companies in a developing market like Ghana? So the country risk premium is more of the equity risk premium, the extra risk associated with the fact that it is so and so country and not the United States. So we take the sovereign default spread and we need to adjust it by a factor. That factor is the volatility of the equity market divided by volatility of the debt market. Now, because we don't rely on the stock market in Ghana, the Ghana stock market volatility may be understated or be misstated. We don't use it. Now, we also don't, our debt also are not trading properly for us to come out with the volatility of our debt. Therefore, we use an index to represent them. For the equity, the index we use is the S&P Emerging Market Index. Okay, so it tracks the equities of the emerging market, and the volatility of that can be used. Therefore, the bond, we use the iShares JP Morgan USD emerging market bond ETFs. The volatility of the returns is used. And then that is what we use to adjust this to get the country risk premium, right? And that model is called the Damodaran model. The Damodaran, Professor Damodaran is the one that produced that model. Now, the last slide is on how then do we incorporate the country risk premium? Now that we've calculated it, how do we get it into the model? How do we add it to the CAPM? Now, how to do that in the CAPM? There are 3 ways suggested by Damodaran. Damodaran says this. He says that the first method is that, and this is this one, continue to run your model the way it is, the equity cost model, the CAPM, and just after calculating everything, add the country risk premium to it. That's the first one. In this case, you assume the full impact of the CRP. And I told you this, that guys, for the banks in Ghana, this is the first thing you should do. This is the first one. Use the first model for the banks here in Ghana. Now, the second model says that, well, the company may not be 100%, or the sensitivity of the, or the exposure of the company to the CRP may be at the level of the beta as well. So add it to the equity risk premium before applying the beta on it. Equity risk premium of the developed market before applying the beta. The third one says, well, apply the beta on the equity risk premium of the developed market, and also delta adjust the CRP, right? Lambda adjust, I say delta adjust. Well, the question, which one will give you a higher CRP? The one that likely to give a higher CRP depends. Because if beta is more than 1, then this one is likely to give you a higher equity risk, derived CRP. Which one is likely to give you a higher expected return? Well, if beta is higher than 1, then this one is likely to give you that. If beta is lower than 1, then it's something else. But for me, I want to be very conservative when I do this for banks. So I can use these 2 methods, and I'll select the one that gives me the higher one. Since I said that the banks give them the full value of the country risk premium, then method 3 is not something I'll advise you. But we can choose between method 1 and method 2. And tomorrow, the first 30 minutes of our lecture will be on calculating the cost of equity for one of the banks. We can do that for Ghana Commercial Bank before we start the lectures tomorrow. So, well, that is it for today. Today, we talked about how to estimate cost of equity. We looked at the beta. We looked at also emerging market considerations. That's what I said we would do. So we calculated cost of equity, and it's been a long day, but a lot of you have been with me, about 21 people, like 19 people. That is 21 minus 2, right? Have been with us to the end. So, and tell me something. What did you learn? Did you enjoy the lecture? And also I understand a lot of people believe because it's on YouTube, so they can always watch. But you see, when we are here, sometimes you're able to ask questions and then I respond to them, right? But then it's fine. God richly bless you, really bless you real good. Thank you very much. And Lordina, bless you too. Family, please, what data should we download so we can follow you while we are calculating for GCB tomorrow? You don't need to download any data, my dear. I will tell you why you don't need to download any data. I'm taking you through all these things, and then I'll tell you the short way, a shorter way to doing the same thing. But I've explained to you the basis upon which all those things are done, right? Mamle said, Mark Jordan said, really long night, but helpful and insightful. Thank you very much. That's great. I enjoyed it. I need to go through the last 2 slides. Great session. Thank you, NLT. Then a lot of information, but we are here. I want some more comments. Those on the call, type something. There are some people who have never typed anything since they joined this call. We are done with the main session. I've said, come in, Cephas, let me hear from you. Isaac, Felix, today you've not spoken. Richard, Thomas, I think Thomas, you spoke to the right. Then I can see nobody should leave. They are coming to tell you something now. EA, please say something. Eric, say something. Dramina, say something. Daniel, say something. All of you should say something. A lot of information, but we are here. Now, say, well done. You know your stuff. Keep it up. Thank you. Now, is this CFA level 2 or level 3? I think what I've done is a combination of level 2 and level 3, but it's mainly level 2. I did few things also that has something to do with level 3, capital market expectation, and I've been combining them in that sense. The CFA paper is not that difficult, so you guys should try it and do right. So far, very insightful, great stuff. Really appreciate Julius. Thank you, Daniel. Sifa said today has been very insightful. Thank you, Kweku. I know. So you can do the CFA program. So Ifri, please proceed. Ifri has a message for you. So Ifri, please proceed.